And that with now, I can do something. Who is that? كان هيتسوق المال اللي تكون معانا الآن ولا بعد؟
Assalamu alaikum warahmatullah. Welcome everybody to Dhofar Food and Investment discussion session for the third quarter financials year 2022. In this session, we have our CEO, Dr. Fadi Al-Asad, and we have COO Ahmed Ali Ghatan, and we have the financial manager Shashanka Augustine. We will start presenting the financials with the finance manager, and after the end of the session, we will take any questions or any discussion from the audience. Shashanka, you can start the financials.
Yes. Good morning to all present here. So let's start our financials for the Dhofar cattle feed. So before we start, I want to highlight to the group members here. Our company board of directors had a EGM on 9th of October, and we have changed our name from Dhofar Cattle Feed to Dhofar Foods and Investments. So you all can see the new logo and the name. So our DFI, we will refer it as now DFI. We have two main units, the feed mill, which sells animal feed. So you can see on your right side, the new logo. It is branded as Al Sanabil. And on your left side, you can see Asafwa, which is our dairy main brand. So going forward, we will be doing a complete rebranding exercise, and you all will see the new products on the market starting from 2023. So having said that, we will go for our main group and the parent financial presentation. So we will cover this agenda, overview, group highlights, then DCF highlights, top line, balance sheet, group financial position, group comprehensive income, group cash flow, the related party transaction, and few ratio analysis with our targets and the receivable payable positions. So a very brief summary of what has happened during the 9 months. This is mainly, I am talking about the company. So we are in a net loss position of 1.3 million. During the period, we have reversed an ECL provision of 858,000. So if not for that reversal, we will be in a 2.2 million loss. And we are losing cash from the business. We will explain in a much detail in the next slides. Around 600,000 for the first 9 months. Our feed mill, which is the Al Sanabil brand owned company, the division, top line decline is around 43%, and the dairy top line increased by 19%. So we have an agriculture division, which is a backward integration to the dairy, and increase the revenue of 1,200% compared to last year, mainly due to our new agriculture crop, papaya harvest and cultivation harvest. mainly declined by feed mill reduction from 25 to 23 million compared to last year to this year. And this top line is broken down into our division wise. So dairy contributes to about 69% and feed mill is about 29%. And other two divisions are shared around 3.1, which is we are selling the grass and the papaya for outsiders, and from the farm side, we sell the beef and the cattle and cattle meat. So let's come to the parent company P&L mainly. So the parent company P&L, we want to highlight the gross profits. So the gross profits are getting impacted because of the material cost increase mainly. So it has slightly declined over a period of time, and the 2020 and 2021 are the COVID years. So 2019 is a normal year without any impact. It was around 23%. And from that 23%, we have declined to 14, 18 and 14. So it's a major decline due to the two main factors, COVID impact 20 and 21, and then the Russian and Ukraine war impact in 2022. So the cash profit or loss from the operations also moving in a similar line. In 2019, we had a cash profit of 2.1 million on account of raw materials were at a affordable level. And it has changed completely in 2021 and 2022. So the main result is we were not able to generate positive cash, mainly on account of unable to pass on the prices to the customers. But in 13th October, we have increased our dairy range, limited range, the consumers after taking the approval from the PACP, Public Authority for Consumer Protection. So 13th October onwards, our half of the dairy SKU are on a higher prices, minimum of about 6 to 7% increase is already been passed on to the customers, since we cannot continue with the 60% cost increase absorbed into our product. So coming back to the parent balance sheet last 5 years, there is no major change. Everything is almost like constant except for investment available for sale. The fair values are up and down, and biological asset slight change. And then the major changes happened during the last 5 years is the investment in property. The company has 3 lands in Sohar, and the land registration has been changed from agriculture purpose to industrial purpose due to the development of the Sohar port where our lands are situated. So because of that, we have taken an increase in the fair valuations since last 2 years gradually because of the land value is appreciating. Coming back to current assets, almost it's constant between 14 to 16 million during the last 5 years. And then from shareholders' equity, the main change in the retained earnings. 5 years before it was 8 million, and now it has dropped down to 3 million on account of last 3 years major losses. So it is correspondingly, it is reducing the net asset per share from 361 paisa to 268 paisa. Then the current liability side, the main change is the payable. The payable amounts are increasing on account of 60% raw material increase in major commodities for our dairy and the feed and the cow herd feeding elements. So that is creating a cash flow issue, cash flow pressures. So let's go to the group financial position. So in the group financial position, we are consolidating our subsidiary Dhofar Poultry Company and International Plastic, and then taking a share of associate from Omani Vegetable Oil and Dhofar Beverages around 30% each. And during the year, the major change happened in Dhofar Poultry financial position. In April 2022, the board of directors of the Dhofar Cattle Feed or Dhofar Food and Investment have increased the share capital of our subsidiary Dhofar Poultry to keep the company floating after 75% of the capital is eroded in that company. So that is the main change in the investment in subsidiary. Other than that, everything's almost the same level. Then in the retained earnings, again, as explained, the group retaining earnings are impacted by the group company, the parent company, and our 100% owned subsidiary companies' losses, mainly DCF, DFI, and DPC. And coming back to the liabilities, the bank borrowings of the parent company is constantly increasing from 9 million last year to 14 million this year. This is, as I explained in the overview, mainly to fund the recurring raw material price increase. So we are not able to pass it full to the consumer. So your company is constantly incurring losses. A minimum of 20 to 30% price increase necessary to maintain the gross profit at 28% and to make a bottom line of about 3% and to pay a dividend of to the shareholders. If that cannot be done, the company will be literally in losses. So the statement of income position, this we have already shown in above summary. This is a group positions. From the group revenue, like from 25 million to 28 million, and parent company from 25 to 23 decline. So the gross profit is also declining correspondingly, and the result is the losses are increasing from parent company from 336 to 1.8 million, and when you adjust the other income, dividend income, and group results, the losses are getting reduced to 1.2 million for the group and 1.3 million for the parent. And the movement of fair value reserve is nothing but the declining in the market price of the quoted shares. The parent company hold a considerable stake in Didik, Salala Mills, Dhofar Insurance. So declining of all these three is impacting the other comprehensive income. Compared to the beginning of the year, 2.2 million is the overall reduction, but in the last year, it was a 2.8 million increase. So the basic earnings per share is the parent negative 17 paisa compared to 7 paisa last year, and for the group it is 15 paisa compared to 12 paisa last year. And statement of cash flows, it is very evident that cash flows before working capital changes is negative for the parent, around 639,000. And when you adjust the working capital changes, it is around 796,000 negative cash flow, or we have borrowed and used for our operations. And coming back to the investing and financing activities, the main highlight is the other bank borrowings. As we mentioned earlier, 4 million has been borrowed to run the operation during the first 9 months. And during the period, we have repaid the term loan of 1.2 million. And already we have taken a loan of 334,000 additional loan. That is the long-term loan was deferred for some period from Bank Muscat, and this is the addition during this period. So net cash and cash equivalent changes is 169,000 negative with opening adjustment of 332. The cash balance is 163 for the parent and 402 for the group. So let's come to highlight quickly for all the shareholders and the investors present here the related party scenario. The company has around 2.4 million receivable from related party, but 90% is contributed by our main subsidiary, Dhofar Poultry Company. Related party payables also the same. We buy the corn and other grains from Salala Mills, so we have a 700,000 to be paid, and our other subsidiary, International Plastic, is the supplier for our plastic dairy cups and dairy trays and caps and bottles. So we had to pay them 593. Related party payables is around 1.4 million. Then comes to the quick analysis of the ratios versus our targets. So for the year 2022, return on asset, return on equity, all in negative. Current ratio is deteriorating on the account of short-term borrowings, what we are doing to fund the business. Over a period of last 5 years, 0.86 has dropped down to 0.64. Quick ratio also the same. And interest cover is also drastically reducing from 2.23 5 years before to 0.22. That will put the company into a very tough position to borrow. And the working capital position is also hugely negative on account of material price increases. And debt to asset ratio is 0.56 and debt to equity is 1.27. Gross profit, we target to go for about 20 to 25%, but we are currently at around 11.4%. Net profit and operational profit also the same way, we are in a negative position. So coming back to the inventory scenario, inventory, we hold average of about 135 days inventory, mainly on account of feed mill grain imports, which we need to import minimum volume for about 2 to 3 months. So therefore, the days in inventory cover is around 135 days. But we always try to keep it at 90 days, but sometimes unable to maintain that number of days. So average collection period, we may try to maintain at 60, but most of our dairy side retail chains are paying around 90 to 120 days. But there is a considerable improvement compared to last 5 years. We have brought down from 157 days to 120. And the payable is the biggest funding source to the company. We have increased our payable days from 5 years before to 86 days to 182 days on account of our suppliers not being paid. So this is the receivable aging summary. How much is under current? 1 to 30, 31, 60, 61, 80 and 181 days. So major part of the receivable that is due is from our related party, as shown in the related party dues, and mainly coming from our feed mill or the Alsanabil business. Dairy business is into a retail customers in Oman market mainly. So it is well under control, and other 2 operating units also well under control. So coming back to the payables. So we are funding the business with the payable. We have to pay around 2.2 million with the receivables of about, we have to pay for payable 4.9 million in line with the receivable 5.2 million. So most of the payables are current, around 45%. And the rest is 14, 3 and 32% and 5%. So that ends our financial presentation. So if any of the forum members have any questions, we can take it up, and Dr. Fadi is also here to give an overview of the future business trend and the business plan.
Yeah, thank you, Shashanka, for this comprehensive presentation. And I would like to share with the with the people here the future plan for us is, we were able to be increase our prices recently, and you have seen in the market about what's going on. So after really hard work with the protection agency, consumer protection agency, we were able to increase the prices. In phase 1, we have increased the prices, and we are getting 7% improvement on our margin. And starting in January, we will be able to double that margin to 12%, because we'll increase the price on other products as well. Now 33 SKUs will increase. The second phase, 34 SKUs will increase, so that will put us in a positive, margin profit for a company. We are also launching innovative products. We have initiated also additional cost savings. We are organizing the company. We also we are letting go some of non-adding value to our company. And also for the feed, which is the most critical one, the feed is we have been working since the beginning of the year to convince the government to give us subsidies, and now they promised us after a really long time. We were fruitful to able to have a verbal that they will give us verbal promise they will give us subsidies. So we're still waiting. We should receive it any time now. And we are also focusing on combined buying, bulk buying, and seasonal buying of raw materials to get the best prices. So we're also using technologies to improve our efficiencies and improve our cost savings. We are also upgrading our logo, as you have seen. All the logos have been upgraded. We have a new name, and we are relaunching our product with a new name and new logo. Upgraded is going to be a very nice design of the packaging. So with all this, we are hoping that things going to move to the positive. Obviously, when you have raw materials increasing by 60%, 46%, and logistics cost by 300%, while you cannot increase the prices, we did a lot of savings, but this saving cannot match with the increase of raw materials and logistics. So this is unfortunate, but this is hitting everyone in the world internationally, not just Oman. Every company I've discussed with many CEOs in the region, and most companies are not doing very well. So also we are looking about basically reorganizing, what's called merging with other companies. So we will be able to strategic partner and consolidation to able to join forces and reduce our overhead costs. This is also very strategic for us, for our group. How can we, as a group of companies, we're able to build our positiveness and able to share our services, so we'll be able to reduce our overhead costs. So next year, I believe it will be a much better year. If things does not escalate in the world, in a war or other things, I believe we will be able to be in a much better position than this year. Thank you. If you have any question, I'm ready to answer it.
Gaurav, Pushpita, and Vicky, anything you all have, we can clarify for you. And if you all don't have anything, maybe within 5 minutes we can close the meeting.
Yes, okay. Mute from their side, huh? Well, come here.
Can anybody please hear? I would like to hear your voices to tell us something. You're there. You're okay. If you have any question.
Okay, then.
Yeah, if you don't have the question.
If they have no question, I think we will close the session, and I think the management identify the hazard from each area, and they quantify the risks also from each area, as we are integrated industrial area, and they are putting a plan to control this hazard and mitigate the risk. We will be improving our performance, and for the last year, we'll have another session for discussion the final year results, inshallah. Goodbye and thank you for everyone.